This video is sponsored by Shortform, more on this later in the video. From a Canadian trader who lost $6 billion in a week, to an investor whose $20 billion empire evaporated in just 2 days, these are the dumbest billionaires of all time. Starting with Wang Sicong, who lost hundreds of millions of dollars of his dad's money in just a few years. Wang Sicong is the son of Wang Jianlin, a Chinese billionaire who had an estimated net worth of $14.4 billion in 2020. Jianlin gave his only son about 500 million yuan in pocket money so that he could try and start his own businesses. That's about 75 million US dollars, which Sicong used in 2009 to start a venture capital business called Porsche Capital. The only problem is that having money doesn't automatically make you a good businessman, a reality that Sicong would come to discover in the next couple of years. He immediately invested some of his money into starting an esports live streaming platform called Panda Live to compete against Twitch TV, the biggest streaming platform in the world, which is now owned by Amazon. But things didn't exactly go as planned. In 2015, it was reported that Panda Live was losing 50 million yuan a year, and just 2 years later, in 2017, its losses had ballooned to 800 million yuan. In 2019, it was announced that Panda TV had shut down due to severe cash flow problems. A Hong Kong court ruled that Sicong was personally liable for approximately 2 billion yuan of debts, which is about 400 million US dollars, meaning not only did he lose all of the money that his billionaire father gave him, but he also managed to rack up debts in the hundreds of millions. But that story has nothing on Thomas Wok, whose bad decision making not only lost him a huge amount of money, but also landed him in prison. Thomas Wok is the second son of Wok Tak Sen, a real estate mogul who founded SHK Enterprises in the 1960s. In its early years, it was buying and developing residential real estate across Hong Kong. The company grew to become the biggest property developer in all of Hong Kong, making Wok Tak Sen a billionaire. However, in 1990, he had a sudden heart attack, passing on his company to his 3 sons, Walter, Raymond, and of course Thomas Wok. This made Thomas Wok an instant billionaire, with the 3 brothers having an estimated net worth of $16.5 billion in 2018. And while for many this would prove as a great opportunity to prove yourself outside of the shadow of a billionaire parent, Thomas's hunger for power would get the better of him. In March of 2012, Thomas and his brother Raymond were arrested in Hong Kong on bribery charges. The brothers were accused of bribing the Chief Secretary of Administration between 2005 and 2007. They allegedly paid the high-level government official for inside information that would help them run their massive property development empire. Thomas was ultimately found guilty of conspiracy to commit misconduct in public office and served 5 years in prison as well as a $500,000 fine. The value of their property company dropped over 25% when the charges were announced, costing them billions of dollars in net worth for the bad decision making. But if you think that's bad, you haven't heard of the Japanese trader known as Mr. 5%, who broke the record for the largest unauthorized trading loss in history. Yasu Hamanaka was an equities trader at Sumitomo Corporation during the 1980s and 90s. He worked as chief copper trader at the investment company and for over a decade was considered the world's most powerful copper trader. Sumitomo Corporation was buying about 800,000 tons of copper every year and selling it mostly to businesses within the Southeast Asia region. And almost all of that volume was traded by Yasao Hamanaka. He was known in the industry as either Mr. Copper or Mr. 5% because that's how much of the world's copper supply he was trading annually. And giving that much control to Hamanaka turned out to be the worst decision in the company's history. In 1996, it was discovered Hamanaka had been engaging in unauthorized trades for over a decade. Because Hamanaka was so well respected at the company, he had very little oversight into what he was actually doing. And that essentially allowed him to hide a long track record of losses year after year. The trades he showed executives occasionally indicated a terrific track record and that the company had huge cash reserves as a result of it. But the truth was, Hamanaka had spent over 10 years chasing huge trading losses like a degenerate gambler. And ultimately, he lost the company a staggering $1.8 billion, which at the time was the largest unauthorized trading loss in history. And he only slightly beat out Nick Leeson's previous record, which was $1.3 billion in losses. But Leeson's story is arguably worse because not only did he lose billions of dollars, he also single-handedly destroyed a 233-year-old bank with a single bad trade. Just before I get to that story, I do want to quickly talk about the sponsor of today's video, Shortform. Shortform is an app that allows you to learn the best ideas from a wide variety of books. Shortform provides super in-depth summaries of each book's key points and concepts concepts and goes above and beyond by building on the top ideas in their book guides. They cover a great range of genres, including books on economics, productivity, and finance. Personally, I like using short form to revisit books that I've previously read, such as Tools of Titans, which I read a few years ago, and also to learn about the key ideas of new books so that I can decide whether or not I want to invest in reading the full book. Each book guide has a one-page summary followed by more detailed analysis of the key concepts. Tools of Titans, for example, shares the habits and beliefs of 101 high-performing people and covers advice ranging from goal setting to business building to fitness practices. Shortform publishes brand new book guides and articles every single week, and best of all, subscribers actually get to vote on which books are going to be covered next. To get a free trial and an additional 25% discount on the annual subscription, join Shortform via my link shortform.com/hodder, or scan the QR code or click the link in the description. But back to Nick Leeson, the previous record holder for the most violent unauthorized trading loss and credited with destroying a 233-year-old company. Leeson was a derivatives trader who had a successful career at Morgan Stanley for a number of years before joining Barings Bank in 1989. Ironically, one of the first things he did at this new job was to investigate a case of unauthorized trading by another employee, which probably should have taught him firsthand the stupidity of doing that, but instead seemed to have acted like a WikiHow guide that he'd use later in his career to absolutely obliterate the bank. In 1992, Barings decided to open a futures and options office in Singapore. Futures and options are types of derivatives that are essentially side bets that you can place to speculate on the short-term movement of stocks or commodities. They can be used to hedge against other investments, kind of like buying insurance, but Leeson was using them kind of like a home office roulette table. By the end of 1992, he had lost £2 million, which he was able to hide by using what's called an error account. Trading firms may make hundreds or even thousands of trades every single day, and because there's humans involved, people are bound to make mistakes when entering in and recording those trades, so an error account can be used to track those anomalies. Leeson used the fact that Barings didn't check this account closely to hide his losses. Within a year, his losses had gone from £2 million to £23 million, and after another year, the losses exceeded £200 million. You see, Nick Leeson had a genius solution to being a bad trader. We all have that degenerate gambler friend who says he never loses money at roulette because he just doubles the bet every time. And as long as you don't run out of money doing this, you'll eventually win and recover all of your losses, right? Right? Well, this was Leeson's exact train of thought, except he just kept losing. In 1995, already down hundreds of millions of pounds, Leeson decided to risk it all on one last bet. He placed what's called a short straddle on the Japanese stock market, and without boring you with how this exactly works, he was basically betting that the Japanese market wouldn't move all that much the next day. So as long as the day was more or less like a normal day where the stock market doesn't move a lot, then he would have recovered a significant amount of the losses that he had accrued for the bank. Well, early in the morning the next day, a 6.9 rated earthquake hit the southern part of Japan, and Leeson's bet got absolutely obliterated. He fled Singapore, leaving an "I'm sorry" note on his desk. In total, he lost Barings £827 million, or $1.4 billion, which immediately bankrupted the 233-year-old firm. There have been some crazy unauthorized trading losses across history, but all of those are pennies when you start to consider traders who have the green light to act like a degenerate gambler. I'm talking about Bill Hwang, who in 2021 lost $20 billion in just 48 hours on a handful of insanely stupid trades. Bill Hwang is a Korean-American trader who had a colorful history in the asset management industry. He admitted to insider trading in 2012, was banned for 4 years for trading in Hong Kong, yada yada yada. Fast forward to 2021 and he's running a new fund called Archegos Capital Management. Archegos in Greek means prince, I think, and he was certainly the prince of something. He was the prince of making some of the dumbest leverage trades I've ever seen, like it was a challenge to lose as much money as possible as quickly as possible. Hwang used what's called a total return swap to basically trick a bunch of investment banks into lending him an absurd amount of money. Instead of just investing in the stocks, the banks bought the stocks on his behalf, and he would receive money from or pay the banks based on how the stock moved each month. It's kind of like when you're 14 years old and you ask your dad to put a bet on a horse horse race for you, and you say that you'll pay him back if it loses, even though you know you have no money. Well, Huang's horses didn't win, and in the end, he owed the banks about $20 billion that he didn't have. I mean, if there's a Hall of Fame one day for the most degenerate gamblers of Wall Street history, then Bill Huang should be the first person inducted. Much like Canadian Brian Hunter, who lost billions of dollars by making bad trades and blamed the trading software for allowing him to make such big bets. Brian Hunter was a Canadian natural gas trader who started out at an energy company called TC Energy before joining the trading team at Deutsche Bank. In the first 2 years, he made almost $70 million for the German investment firm, which led to him being promoted to the head of natural gas trading. According to Sebastian Mallaby, who wrote about Hunter in his book More Money Than God, in December of 2003, Brian Hunter's team lost $400 million in a single week on a single trade. Hunter claimed that the loss was an unprecedented and unforeseeable run-up in gas prices, and that he shouldn't take responsibility for the enormous loss. He also went on to blame Deutsche Bank's trading software for even allowing him to make such a reckless bet. How dare the casino allow me to put my life savings on red? It's all their fault. Of course, he was fired from Deutsche Bank, but he was on a mission to lose even more money for somebody else. That unfortunate person was Nicholas Maunis, the founder of Amaranth Advisors. In 2006, while working at Amaranth Advisors, Hunter took a huge bet that gas prices would rise in winter and fall in summer. So he used derivatives contracts to bet long on winter gas deliveries and short on summer deliveries. And he was completely wrong. I couldn't find the exact derivatives that he was using, but I'm gonna go ahead and assume that he was using futures contracts, which means he would have been locking his firm into buying and selling natural gas at fixed prices at a fixed point in the future. So as the prices moved against him, the losses just grew and grew and grew, and at the end, the fund lost about $6.6 billion from the trade and was forced to shut down. But a list about the dumbest billionaires wouldn't be complete without the mention of Elizabeth Holmes, who went from being the female Steve Jobs to facing 11 years in federal prison. Elizabeth Holmes founded a blood testing company called Theranos in 2003 with the promise of being able to deliver blood tests by only using a pinprick of blood, which was something that was unheard of in the field. In fact, before she founded the company, she asked a bunch of experts if it was possible, and all of them said no, it's not physically possible. Some of the most common blood tests involve exposing a sample of blood to different chemicals, which is why a doctor will often take 1, 2, 3, or even more vials of blood for doing a full range of testing. But that didn't stop her from going full steam ahead with her idea. In 2004, she raised $6 million from investors, and the money just kept rolling in year after year. Eventually, by 2014, the company was valued at $9 billion, making Holmes the youngest female self-made billionaire. Theranos at the time was doing millions and millions of tests a year, including for some very serious illnesses such as types of cancer and HIV. The only problem was the testing was completely fraudulent. The beginning of the end came in 2015 after a Wall Street Journal article exposed the fraud going on at Theranos. The article alleged that the company had been lying about the accuracy of their testing, and that many of the tests were being done on third-party machines, not their revolutionary Edison machine. 2 years later, the SEC sued Holmes for fraud, and in 2018, a grand jury indicted Holmes on 9 counts of wire fraud and 2 counts of conspiracy to commit wire fraud. Her trial ended in 2022, and she was sentenced to 11 and a quarter years in federal prison, which is where she is today.